Welcome to the Deep Dive. Today we're immersing ourselves in the Q2 2025 earnings call for Sotherly Hotels, ticker SOHO. This call went down during market hours August 12th. And for you, the listener, it really presents this fascinating split, doesn't it? You had some pretty bad operating news, but it felt like it was almost completely overshadowed by some, well, pretty crucial financial maneuvering.
That's exactly right. Yeah. If you just looked at the headline operating numbers, you'd honestly expect a sell-off, no question. But this call, it was really a textbook case, a company fighting these pretty severe operational headwinds, while at the exact same time pulling off some intense balance sheet triage.
Right. Triage is a good word for it.
And the market reaction tells the story. It was very muted. Shares actually ticked up slightly. It suggests investors were, much more focused on management getting its financial house in order rather than the softer revenue figures.
Okay, let's unpack that right away. We're diving straight into those Q2 figures. Maybe we can structure it, thinking about top line pressure first.
Sounds good. So top line pressure. Total revenue, it came in at $48.8 million. That's a pretty clear 3.7% drop year over year.
Not ideal. And the core metric, RevPAR.
Yeah, RevPAR revenue per available room that dropped 5.4% compared to last year, landed at $130.20.
And what drove that RevPAR drop? Was it rate or occupancy?
Mostly occupancy. It fell about 350 basis points. So yeah, like you said earlier, a significant number of empty rooms.
Okay, so that's the top line pressure. But then under that, you mentioned the margin compression.
Exactly. Hotel EBITDA took a sharp hit, down 11.5% to $13.9 million.
Wow, okay, so revenue down less than 4%, but EBITDA down over 11%. That really shows the operating leverage working against them, right?
Absolutely. When occupancy falls like that, every dollar of lost revenue just hits the cash flow much harder. Because, a lot of hotel costs, they're pretty fixed, utilities, some staffing. It's hard to cut those quickly.
And that margin pressure flows right down to the bottom line figure everyone watches for REITs, adjusted FFO.
It does. Adjusted FFO, funds from operations, saw a, frankly, dramatic drop. It was down 36.6% year over year, came in at just $4.8 million for the quarter.
36.6%. Okay. So if you see that number in isolation,
you would run for the hills.
Right. You'd ask, why on earth did the stock close higher that day? It doesn't make sense on the surface.
And that's the fascinating part, that that sort of benign reaction from the market, a revenue miss, a, pretty catastrophic FFO drop. Normally, that triggers a sell-off.
So what's the theory?
The fact it didn't suggest, well, one of two things. Either the market already fully expected this operational softness, it was priced in, or, and this feels more likely, the bad news was just completely neutralized by the confidence management projected about their liquidity moves, their balance sheet execution.
So this deep dive, it's really a story about balance sheet mechanics, not so much about hotel guests this quarter.
Precisely.
But speaking of the operations, the softness there.
Yeah.
Management pointed to the usual suspects, right? Macro uncertainty, high interest rates, maybe some tariff stuff.
Yeah, the general headwinds were mentioned. But there is something much more specific and frankly pretty surprising that kept coming up on the call.
Okay, what was that?
Well, they repeatedly mentioned the impact of let's call them defense or government agency program cuts. That seemed to be the specific phrase or close to it. It refers to a really noticeable pullback in government-related travel and spending that seems to hit Sotherly's specific portfolio mix.
Okay, so this isn't just like a few government employees taking fewer trips.
No, not at all. Management was clear. It's not just the direct government travel, military TDYs or whatever. It's the indirect business too, and that's vital. Meaning like large group events, associations, government contractors, consulting firms, groups whose funding ultimately traces back to government budgets. When those programs get cut or maybe funding gets frozen, poof, that group business can just evaporate.
Okay, that makes sense. And which hotels felt this most acutely? I'd guess the D.C. area ones, Arlington, Laurel.
They definitely got hit hard, yes. But the surprise was how far it extended beyond the D.C. Beltway. It hit their hotels in Atlanta, and this was the real eyebrow raiser, Savannah.
Savannah, wow. I saw that data point too. RevPAR in Savannah, down almost 10% year over year. Yep. That's unexpected. You don't typically think of Savannah having that level of direct government exposure.
No, you don't. And analysts on the call were clearly surprised, too. They tend to see Savannah purely as, a leisure destination, historic charm, tourism.
So what was management's explanation?
They explained that a pretty meaningful chunk of their group nights there actually comes from sort of military-adjacent groups and association business tied to nearby bases or government functions. And the pullback wasn't just like outright cancellations. They also noted the groups that did come were much more cautious with their spending. Less spent on banquets, catering, the high-margin extras.
Ah, so it hits the ancillary revenue too.
Oh,
Okay.
yeah.
But here's where we circle back to that glimmer of operational strength you mentioned. Despite the occupancy drop, despite these headwinds, the average daily rate, the ADR, it held up pretty well overall.
It did. And that resilience, it suggests a couple of important things. First, it implies management's holding firm on pricing. Good rate discipline. They're not just slashing rates to fill rooms.
Resisting the temptation.
Exactly. And second, it suggests the customers who are still coming are maybe less price sensitive. They seem to be holding on to the higher end leisure jets and maybe some smaller corporate bookings.
Okay. And did they give any outlook on that front?
Yeah, and this was crucial for calming nerves, I think. Management gave some positive operational visibility. They said the group booking pace for the rest of the year, so H2 2025, it actually looks pretty solid. They used the phrase step forward, I believe, compared to this soft Q2. So that provides a bit of light at the end of the tunnel operationally.
A bit of light.
Yeah.
But that operational picture, however stable it might become, it really feels secondary right now, doesn't it?
Completely secondary.
Because we absolutely have to talk about the elephant in the room. The reason this call was so critical.
That's the balance sheet.
This is the core narrative.
Yeah.
Sotherly's almost desperate but definitely active approach to tackling their near-term debt maturities, and specifically the situation at the Georgian Terrace Hotel in Atlanta.
Okay, lay it out. What happened there?
Well, this was the bombshell on the call. Really material, pretty severe credit news. Management had to disclose they'd received a formal notice of default on the mortgage for the Georgian Terrace. That notice came back on July 2nd.
A notice of default while they were trying to negotiate an extension.
Exactly. They were in talks trying to get an extension, but the lender went ahead and issued the default notice. For a company Sotherly's size, getting a default notice on a flagship asset like that, it's a huge deal, a defining credit event.
Okay, so technical default. That demands an immediate, probably high-stakes solution. What was their plan? Their answer was, well, creative, but also, pretty risky. They decided to rely on selling a non-core asset to fix this really critical debt problem.
Which is us.
They moved fast, signed an agreement to sell a large parking garage over 700 spaces that sits right next to the Georgian Terrace.
Selling the parking garage. Okay.
The sale price is $17.75 million. And here's the crucial part. Those proceeds are specifically earmarked to pay down the mortgage on the Georgian Terrace, the one in default, to cure that default.
Wow. Okay. And when is this sale supposed to happen?
The target closing date is Q4 2025, so pretty soon.
So the fate of their biggest immediate credit problem hinges entirely on successfully closing the sale of a parking garage later this year. That's quite a situation.
It's an amazing twist, isn't it?
Yeah.
High drama for a hotel REIT earnings call.
Definitely. But that's only part of the balance sheet story, right?
Yeah.
Selling an asset to cure a default.
Yeah.
That's defense. Did they manage any offense? Any successful refinancing?
They did. And this was another key piece of news, happened post-quarter end. They successfully refinanced the loan on their DeSoto property down in Savannah.
Okay. What were the terms there?
They secured a $42.0 million loan. Importantly, it's interest only. And it extends the maturity out 5 years to 2030. So that does reduce uncertainty on that specific property.
Pushes the maturity wall back.
Ah.
But what about the cost? What was the rate?
Ah, yes. The rate. It's fixed at 7.13%.
Oh, yes, 7.13%.
Yeah.
Interest only.
It's elevated, eye-wateringly so, if you look back historically.
Wait a second. Is that really a success? Getting an IO loan at over 7%? That sounds less like a triumph and more like maybe a move they had to make to avoid another potential default situation. Does that high cost really reduce uncertainty or just increase their debt service burden down the line?
That's a really important question, and the answer is probably both.
Right.
It absolutely reduces the immediacy of the risk on that loan, kicks the can down the road, which the market desperately needed to see. But yes, you're right, it dramatically increases their long-term cost of capital.
So it buys them time, but at a steep price.
Exactly. And connecting this to the bigger picture, management was pretty candid. They said the length and environment for hotels is still stubbornly challenging.
What makes it so challenging right now?
Well, they mentioned debt yields are still high compared to, say, pre-pandemic levels. Lenders basically require hotels to generate significantly more profit relative to the loan amount just to feel comfortable. And the debt service coverage ratios, the cushion lenders demand, those are much tougher now too.
So lenders are still pretty cautious.
Very cautious. However, management did say they're starting to see, quote, cracks and some stabilization in the debt markets. So there's maybe some cautious optimism that they can tackle the remaining maturities, like the one on the DoubleTree in Hollywood, Florida. But it won't be easy or cheap.
Okay, so this intense focus on fixing the balance sheet, dealing with defaults, refinancing at high rates, what does it all mean for the shareholder? Did the updated guidance reflect this push and pull?
It did. The updated full-year guidance is, let's say, measured. The numbers are pretty mixed, reflecting exactly that tension. Hope for an operational recovery versus the reality of rising financing costs.
Give us the highlights.
All right. Full-year 2025 revenue guidance, the midpoint implies about a 2.6% increase over last year. So that suggests they do expect a significant operational bounce back in the second half of the year.
Okay, revenue up. But what about profitability? Hotel EBITDA.
That's where the story flips. The hotel EBITDA guidance midpoint implies a 2.6% decrease year over year.
Whoa. Okay, hold on. Revenue up 2.6%, but hotel EBITDA down 2.6%.
That divergence is critical, isn't it? That's pure margin pressure right there.
It absolutely is. It screams that cost pressures, labor, utilities, and definitely that much higher interest expense from loans like the DeSoto one are basically eating up any top-line growth they might achieve.
So operationally, they might tread water or slightly improve, but the financial structure drags down the cash flow. That seems to be the implication. Overall, RevPAR for the full year is expected to be roughly flat. And adjusted FFO, the bottom line for REITs, is projected somewhere between 34 and 37 cents per share.
A very measured outlook then. It really anchors expectations almost entirely on execution, especially on that balance sheet side.
Totally. And when you look at the stock chart, it makes sense. SOHO has lagged its benchmark significantly. It's down, around 32% over the last year. Meanwhile, the broader REIT ETF, VNQ, has been roughly flat.
Right. It just hammers home the point you made earlier.
Yeah. SOHO's stock performance isn't really about broader travel trends right now. It's almost entirely driven by company-specific balance sheet risk, refinancing risk, default risk.
Which makes that parking garage sale in Atlanta
the single most important must-watch catalyst for Q4. Until that cash is in the bank and that Georgian Terrace loan is cured, nothing else matters nearly as much.
Okay, this brings us perfectly to our final segment.
Yeah.
Given everything we've discussed, it begs the question, how might someone even think about positioning a trade around a microcap stock whose immediate fate literally hangs on selling a $17.75 million parking garage?
Yeah.
Now, obviously, this is absolutely not financial advice, just a high-conviction thought experiment. Pitch us a wild but maybe plausible idea based on this situation.
Okay, not advice. Got it. Well, given SOHO's relatively thin trading volume, its small size, and how we saw the stock react to that muted positive move just on signing the garage sale agreement.
Right, the market gave him some credit, but not full credit yet.
Exactly. The market seems to be saying, okay, we see the plan, but we need to see the cash. So the idea, the thought experiment, is maybe a highly targeted, very time-sensitive long position, specifically heading into Q4.
Okay, and the detailed thesis behind that hypothetical trade?
The thesis is straightforward. Go long, SO, betting entirely on the definitive closing of that Atlanta garage sale sometime in Q4 25. And critically, the successful use of those proceeds to cure the default on the Georgian Terrace loan.
So you're betting on execution.
Pure execution. The trade aims to capture the potential re-rating if, and it's a big if, that major near-term credit overhang, the default notice from July, gets completely resolved through this asset sale. If they pull it off, it should lead to a pretty significant reduction in the risk premium currently baked into the stock price. You could potentially see a sharp upward move as that balance sheet risk visibly evaporates.
Risky. High conviction.
Yeah.
And utterly dependent on the closing documents for a parking garage. Okay, yeah. We love it purely as a theoretical pitch.
It's about as event-driven as you can get. Pure execution risk.
So to wrap up this deep dive, a really cautious quarter on the operational front for Sotherly, dominated by those macro pressures, the surprising impact of government funding cuts. But ultimately, that was all overshadowed. The real story was management signaling very strong intent and showing active execution. on fixing the balance sheet.
Absolutely. Execution on that garage sale is paramount now, and then tackling the remaining refinancing schedule. Until that Atlanta default cloud is fully lifted, DeSoto stock remains fundamentally a balance sheet story. It's driven by credit risk, not really by lodging demand trends right now.
Well, thank you for joining us on this deep dive. We hope you, the listener, feel a little more well-informed and maybe, just maybe, have a new appreciation for the high-stakes drama that can unfold around hotel debt, where sometimes the successful sale of a single parking garage can quite literally decide the near-term fate of a REIT. Tune in next time.